Forget the chart for a moment. Forget the RSI, the moving averages, the colorful indicators that tell you what already happened. In moments like this, the most important signal in the silver market isn't price, it's time. Specifically, how little of it the system seems to have left. Markets don't break when headlines say they will. They break when institutions quietly start acting before the headlines exist. That's what makes this moment so dangerous and so revealing. While most investors were watching screens, two things happened almost simultaneously beneath the surface. In the West, a central bank stepped in with unscheduled liquidity off the normal calendar, early in the trading day. That doesn't happen in a calm, well-functioning system. It happens when something is about to fail. At the very same time, on the other side of the world, a massive amount of physical silver was removed from public exchange vaults in Asia, not traded, not shuffled on paper, but physically taken out of circulation. No press conference, no explanation, just action. That's the tell. One system needed newly created liquidity just to make it through the morning. The other needed real metal secured before a deadline. These aren't random events. They're stress signals synchronized, directional, and urgent. If one side needed liquidity to survive the morning, the other side needed metal to survive the future. What we're witnessing now isn't just volatility, it's a divorce. Two markets that used to pretend they were one are finally pulling in opposite directions. On one side, you have the Western financial system, derivatives stacked on derivatives, leverage layered on leverage, all held together by repo funding and confidence. This is a world where silver exists mostly as a contract, a promise, a number on a balance sheet. When stress appears, the response is predictable: inject cash, smooth the plumbing, keep the paper machine running. On the other side is a very different system. The Eastern market doesn't care about balance sheets. It cares about production. Factories don't run on futures contracts. Solar panels, batteries, electronics, and defense systems require atoms, not promises. So when risk rises, the response isn't liquidity, it's extraction. Metal is pulled from vaults, loaded out, and locked away to secure supply chains. This is the core contrast. Paper markets defend solvency on spreadsheets. Physical markets defend the ability to manufacture, to build, to function in the real world. Liquidity can postpone a crisis, but it can't replace missing material. You can print currency overnight, you cannot print silver. And that's why this moment matters. Because this split only becomes visible when something breaks, and something did. Every systemic crisis has a trigger signal, something institutions see immediately, even if the public doesn't. In this case, that signal wasn't a headline or a crash on the screen. It was sudden stress in the repo market, appearing alongside violent moves in silver before most traders had even finished their morning routine. Here's why that matters. The repo market is where banks and large funds borrow short-term cash against collateral. In a healthy system, it's quiet and boring. When it flares up unexpectedly, it means trust has cracked. Someone needed cash now and couldn't get it from other banks. That's not routine. That's refusal. Layer silver on top of that stress, and the picture sharpens. The largest players in the silver market carry massive, concentrated positions. When volatility spikes, exchanges demand more collateral immediately. These aren't polite requests. They're margin calls with deadlines measured in minutes, not days. If the cash isn't there, positions get liquidated and failures cascade. That's why emergency liquidity, especially outside the normal schedule, is such a red flag. It signals that a private counterparty was on the brink to exposed, too leveraged, and suddenly short of cash. Silver didn't cause the panic, it exposed it. And when the paper system panics, the physical system doesn't hesitate, it extracts. Now we move from screens to warehouses, from abstractions to weight. What happened in Asia wasn't active trading or routine rebound. It was physical removal at scale. In a matter of hours, tens of tons of silver were taken out of public exchange vaults. Not swapped between accounts, not rolled forward, loaded out, gone. To understand the gravity, you have to think in industrial terms. That amount of metal represents enormous productive capacity. Solar manufacturing, battery systems, electronics, defense applications, and just as important as what left is what remains. After the withdrawal, reported inventories fell to levels that don't represent months of supply, but weeks. That's not a buffer. That's a countdown. This behavior tells you everything about intent. Nobody pulls that volume of metal because they think prices are going lower or supply is comfortable. This is preemptive stockpiling buyers racing the calendar, locking in material ahead of regulatory tightening and potential export constraints. It's the kind of move made by entities that cannot afford to be short metal later at any price. Paper markets can churn billions of ounces in volume without moving a single bar. Physical markets can't fake it. Inventory is the truth serum. When metal is withdrawn instead of traded, it signals fear not of price, but of availability. And once physical metal starts disappearing, paper prices require more force, more leverage, and more intervention to stay believable. This is where the story stops being complicated and starts being mathematical. On the paper exchanges, silver doesn't trade like a scarce commodity. It trades like a video game token in a single session. The futures market can churn through an amount of silver that equals a massive share of annual global mining output, sometimes more than an entire year's supply without requiring the metal to exist, move, or be delivered. But here's the part that matters. Almost none of that paper activity ends in physical delivery. Contracts are opened and closed, flipped and netted, creating the illusion of endless supply. This is how price is managed. If you can create thousands of claims for every real ounce, you can draw on real demand in synthetic volume. That works until it doesn't. This is what leverage saturation looks like. When the number of promises grows to large relative to the metal that can actually be delivered, the market stops being governed by charts and starts being governed by confidence. The moment participants question whether delivery is possible, the entire structure becomes unstable. This also explains why arbitrage is breaking down. In theory, traders should buy where silver is cheap and sell where it's expensive. In reality, that requires metal to move. When export rules tighten and inventories thin, the bridge collapses. The paper price becomes a reference, not a reality. At that point, leverage loses its power. And when leverage stops working, power shifts from traders to holders. This is where silver stops being just a commodity and starts acting like a stress test for the entire financial system. Large banks and funds aren't exposed to silver because they love the metal. They're exposed because of derivatives. Futures, options, swaps, and structured products tie silver price movements directly into balance sheets. When volatility spikes, risk models break. When risk models break, margin calls follow. That's how the doom loop forms. Silver volatility forces institutions to raise cash. To raise cash, they lean on short-term funding markets like repo. When repo tightens, central banks step in to keep the system liquid. But that intervention doesn't remove risk, it merely postpones it. It amplifies volatility by signaling stress to the market. This is the critical distinction most people miss. Liquidity is not the same thing as stability. Emergency support doesn't mean the system is strong. It means it couldn't survive the day on its own. Bailouts are not confidence boosters. They're confessions. And here's the hard limit. Central banks can create currency instantly, but they cannot create commodities. They can calm funding markets, but they cannot refill empty vaults or reverse physical shortages. Every round of intervention solves a cash problem while leaving the material problem untouched. So while the West patches balance sheets, the East is rewriting the rules. To understand what's happening in silver, you have to zoom out beyond markets and into geopolitics. We're entering an era defined by resource nationalism, industrial policy, and a quiet rejection of dollar-based dependency. In that world, silver isn't a speculative asset, it's a strategic input. It sits at the center of energy infrastructure, advanced electronics, military systems, and next-generation manufacturing. This is why the behavior looks so different across regions. Countries with deep manufacturing bases don't ask, is silver cheap? They ask, will we have enough? For them, metal equals continuity of production, of power, of sovereignty. Accumulating physical resources isn't a trade, it's insurance. The West, by contrast, has spent decades financializing everything. Metals became ETFs, swaps, and paper proxies useful for yield and hedging, but detached from physical reality. That system works only as long as supply is abundant and trust is intact. Both are now under pressure. This is also why gold and silver are drifting away from traditional fiat logic. As currencies are managed and debt expands, tangible inputs regain political importance. When nations start thinking this way, prices stop being the primary signal. Control does. So what does this mean for you right now? This is the part where noise usually takes over, but it shouldn't. Moments like this don't reward prediction. They reward positioning. The goal isn't to guess tomorrow's price. It's to understand what you actually own and why. Start with the distinction that matters most. Ownership versus exposure. Paper instruments can track price, but they also carry counterparty risk, especially when stress moves from markets into plumbing. Physical metal doesn't depend on a clearinghouse, a balance sheet, or a bailout window. That doesn't mean it's risk-free, but it is structurally different. Volatility in this context isn't a warning sign. It's a signal. When price swings widen while inventories shrink and premiums expand, the market is telling you something is misaligned. That's not a moment for panic selling. It's a moment for patience and discipline. Asymmetric setups rarely feel comfortable in real time. Pay attention to the indicators that can't be spun: reported inventory levels, regional premiums, delivery delays, and policy changes around exports or margins. These move slower than headlines, but they matter far more. Price follows them eventually, not the other way around. None of this is about all-in bets or blind certainty. It's about measured exposure, realistic allocation ranges, and the willingness to sit through turbulence. We are not at the end of the story, we are at the handoff. As markets stir, a final, measured rally emerges, not loud, not chaotic, but resolute. This is the quiet transfer of wealth, from paper promises to tangible reality, from speculative illusions to metal in hand. Those who have watched patiently, who understood the signals, and acted before the crowd, are now witnessing the reward of timing and insight. Scarcity reshapes value, reminding us that what is real cannot be created at will. The windows of opportunity are closing, not with sirens, but in subtle shifts. Few notice, yet every attentive eye sees. Stay informed, stay prepared, and recognize the historic rhythm unfolding. Being early isn't luck. It's awareness, learn, adapt, and act deliberately, because this is the moment history will quietly remember.